Hey, what's up, you guys? Swan here from Swan Things. And today we'll be exploring one of the most hotly debated topics in investing, which is stock picking versus passive index investing. Now, the question of which strategy is superior will help you decide how you should invest your own money. Should you trust a professional or even yourself to pick stocks, or do you stand a better chance to get higher returns by simply dumping all of your money into low cost index funds? So, in this video, I looked into the facts and statistics when comparing these two options. So, without further ado, let's begin. Just to give you a background into the two camps of this debate, the first group believes in active fund management. These will be your day or swing traders, value investors, professional fund managers, or just anyone who buys into individual company stocks. This group believes that a skilled investor is able to use various strategies to pick a winning stock or to time the market in order to beat the average return of the market as a whole. The second group are your passive investors, which could be ETF or index investors. This group believes that it's extremely difficult or nearly impossible for anyone to beat the market over the long run. And so they say the best way to invest is to simply buy the entire market through ETFs or index funds. They further eliminate the need to time the market through dollar cost averaging by investing in regular intervals. To figure out which method works best, we will investigate just how easy it is to consistently beat the market. Now, here we will be looking at statistics and not personal experiences. It is very easy to say that if you had bought Tesla or glove stocks a year ago, you could have easily beaten the market. However, hindsight is 2020, and we will look into just how easy it is to make these predictions before they happen. After all, if it's a matter of skill, you will most definitely find consistent outperformance in historical data. So without further ado, let's get into the numbers. You hear all the time that 90% of stock investors lose money. Well, it turns out no one bothered to check because there is no credible source that can confirm this number. In fact, the only statistic that comes anywhere close is that 99% of day traders end up losing money. Although this is a scary number, this only applies to day traders, defined as people who buy and sell the same stock within the same day. Day traders are found to seriously underperform because they fail to account for transaction costs and they trade too often, making many mistakes. Trading too often is in many research linked to poorer performance. On average, the active investor can expect to earn 5% less than the typical investor. On the other hand, most investors are expected to underperform the market by about 1.5% a year. Now, I do want to stress here that underperforming the market does not mean that you are losing money. It just means that you're earning less money than you would if you had just bought an index fund. For example, if the index fund returns 10% a year, the average investor will probably earn 8.5% based on this number. Now, earning 1.5% less may not seem like a big deal, but consider this. If you invest 500 ringgit every single month for 30 years, that 1.5% is the difference between you being a millionaire or falling short by over 200,000. So when you look at the average investor, the statistics aren't too bad. After all, most investors are still making a profit. However, you do have to take into account that this average is calculated in any given year. When you look at longer time periods, the odds become less favorable. In one study, it was found that over a 7-year period, 40% of investors end up losing money, 50% of investors underperformed the market, and only 10% of investors were able to consistently beat the market. Interestingly, the number of investors that were able to beat the market consistently actually decreases as we move into the modern age. In fact, a study done in the 90s showed that 25% of investors were able to consistently beat the market, while only 25% of investors lost money. Some argue that this is because the markets are getting more efficient. Because information and advanced technology is readily available to all investors, stock prices tend to adjust very quickly to any news. And so it becomes difficult for investors to find undervalued stocks to outcompete other investors. Overall, it is clear from the evidence that it is possible for individual investors to consistently beat the market in a reasonably long time period. However, this breed of investors is rare, as they rank in the top 10% of all investors. Now, this is where professional fund managers might come in to convince you that they have skills better equipped to beat the market. Well, logically, this makes sense. Of course, professionals are better at stock picking, right? Unfortunately for these fund managers, their performance is well documented. Embarrassingly, 95% of all professionally managed funds in the US failed to beat the S&P 500 over a 15-year period after fees. When you look at the performance before fees, 16% of funds were actually able to beat the market. Still, 16% is an ugly number, which calls into question why we pay so much of our money to these supposed professionals given their general inability to beat the market. To make matters worse, out of the 16% of funds that do beat the index, 12% of them charge so much fees that you don't get any of that advantage. They pocket the gains for themselves, leaving you with just the average market return. So maybe it's a better idea to invest your money into index funds instead. When it comes to risk of loss though, 40% of individual investors end up losing money compared to only 3% of professionally managed funds. However, this could be due to the fact that fund managers that underperform can be replaced, and so the performance of unit trusts are unlikely to stay negative thanks to the hiring and firing of fund managers. You might note that many of these studies compare the performance to the S&P 500 index. In the past 10 years, this index has returned an average of 13.6% per annum. In Malaysia, out of the 1,364 unit trusts available, only 2 were able to beat the S&P in the same 10 years. You might argue that this is an unfair comparison, but at the end of the day, when you are choosing an investment product for your hard-earned money, this comparison makes sense because you can choose to invest in the S&P 500 compared to these unit trusts. As for my personal thoughts, I think it's pretty clear from the statistics that most investors would be better off investing in a low-cost index fund or ETF. After all, this technically gives you a 90% chance to beat any stock picker out there. However, you do have to remember that this only applies to the S&P 500. Other indexes might fare better or worse. Another thing to be cautious about is that you should not assume that the S&P will continue to do well forever. Although unlikely, there is a chance that US companies might not be as profitable and dynamic as it is today. And so to hold all of your investments in one single index may not be the best idea. Other than that, I personally hold an equal portion of my funds in low-cost index funds as well as individual stocks just to see if I could beat the market. I am fully aware there is a high chance that I will fail and a reasonable chance that I might lose some money. But it's a risk I'm willing to take and I do enjoy the challenge. And that's all I have for you today. Just to recap, for the average investor, a low-cost index fund based on the S&P might be your best bet to grow your wealth. If you want to know how you can invest in these in Malaysia, do check out this video here. With that said, the evidence does show that about 10% of investors can consistently beat the market in the long run. Do you have what it takes to be in that 10%? That is a question I'll leave up to you. As always, smash that like button if you found this video useful, and subscribe to my channel and hit that notification bell for more personal finance content. Thank you so much for watching, and I'll see you in the next video. Bye!